The skeptics said it was impossible. The traditionalists said silver would never break its old records. But here we are on December 19th, 2025, and silver just smashed through $67 per ounce. Not 66, not 65, $67 and climbing. And if you think this is just another speculative bubble, you haven't been paying attention. This is the London squeeze becoming official. This is a supply crisis, 5 years in the making, finally reaching its breaking point. And this is just the beginning. Let me give you the numbers that should terrify anyone short silver or anyone who waited too long to buy. Silver opened this year at around $29 per ounce. Today, it's trading at $67. That's a 130% gain. 130%. In less than 12 months, gold, the safe haven everyone worships, up about 60%. Bitcoin, the digital revolutionary, hemorrhaging 30% from its all-time highs. Silver is the single best performing major asset of 2025, and the mainstream financial media is barely covering it. But the real story isn't just the price, it's what's happening behind the scenes. It's the London squeeze that market insiders have been whispering about since October. It's the fact that physical silver is disappearing from vaults faster than it can be replaced. It's the reality that we're watching a structural supply crisis unfold in real time, and most investors have no idea what's coming next. The London squeeze, nobody saw coming here, is what they don't tell you on financial television or in Bloomberg headlines written by people who've never touched a silver bar. For decades, London has been the epicenter of global silver trading. The vaults beneath the streets of the financial district held hundreds of millions of ounces. Banks traded paper contracts backed by physical metal sitting in those warehouses. The system worked until it didn't. In June 2022, the London Bullion Market Association held 31,023 metric tons of silver. That's over 1 billion ounces, enough to supply global demand for months, but then something changed. By March 2025, those same vaults held just 22,126 metric tons, a 30% decline. Nearly 300 million ounces vanished. Where did it go? India, the United States, Shanghai, everywhere except London. And then came October. The squeeze that veterans are comparing to the Hunt brothers' attempted corner in 1980. Except this time, nobody's manipulating the market. This time, it's pure mathematics. Supply versus demand. Physics versus finance. In early October, silver lease rates, the cost of borrowing physical metal in London, exploded to over 30% on a one-month basis. 30%. To put that in context, normal lease rates hover below 1%. When traders are paying 3,000% more than usual to access silver for 30 days, that's not a market. That's a panic. Silver prices in London traded at premiums of up to $3 per ounce over New York. $3 might not sound like much. But in commodities, markets where arbitrage opportunities typically last seconds, a $3 premium persisting for days meant one thing. There wasn't enough physical silver in London to meet demand. Period. Traders did something almost unheard of. They started booking cargo space on commercial airline flights to ship us silver bars from New York to London. Not container ships, not cargo vessels, passenger flights. Because even paying premium air freight rates was profitable when London silver commanded such massive premiums. The situation got so extreme that by mid-October, one-month lease rates were still running at 14%. Even after massive shipments of silver arrived from New York, Shanghai, and ETF liquidations, the London market remained historically tight. As one veteran trader put it, "I have seen nothing like it ever. What we are seeing in silver is entirely unprecedented. Why this time is fundamentally different. Previous silver rallies were driven by speculation. The Hunt brothers in 1980, the post-financial crisis safe haven bid in 2011. Those were demand shocks that resolved when prices rose enough to crush speculative positions. This isn't that. This is a structural supply deficit meeting exponential industrial demand, and there's no easy way out." Let's start with the supply side, because this is where the crisis begins. Global silver production peaked in 2016 at 900 million ounces. Since then, mine output has declined by an average of 1.4% annually. In 2023, mines produced 814 million ounces. That's nearly 10% less than the peak, during a period when industrial demand exploded. And here's the problem that keeps mining executives awake at night. Roughly 70% of silver is produced as a byproduct of copper, lead, and zinc mining. You can't just open a new silver mine when prices rise. You can't turn on production like a faucet. Silver output is tied to base metal economics, and base metal production has its own constraints. When copper mines slow down because of lower copper prices or operational issues, silver supply falls too. The market can't respond to price signals the way economics textbooks promise. Now flip to the demand side, and you'll understand why this supply crisis is accelerating. The Silver Institute projects a supply deficit of 115 to 120 million ounces for 2025. That's the fifth consecutive year of deficits. Cumulatively, the world has consumed nearly 700 million ounces more silver than it produced over the past 4 years. That's almost an entire year of global mine output just gone. Pulled out of vaults, turned into solar panels, melted into circuit boards, used up and unrecoverable. Solar panel manufacturers alone are projected to consume 25% of global silver output by 2030. 25%, one industry, and solar deployment is accelerating, not slowing. Every gigawatt of solar capacity requires thousands of ounces of silver for photovoltaic cells. There's no substitute that works as efficiently. You either use silver or your solar panels underperform. Electric vehicles add another layer of structural demand. Each EV contains 25 to 35 grams of silver in electrical switches and contacts. That doesn't sound like much until you multiply it by millions of vehicles annually. Global EV sales are projected to reach 20 million units in 2025 and 35 million by 2030. Do the math. That's 750 tons to 1,000 tons of silver demand from EVs alone this year, climbing to over 1,200 tons by decade's end. And then there's artificial intelligence, the demand shock nobody anticipated 5 years ago. AI data centers require massive electrical infrastructure, high reliability components, dense server racks with thousands of circuit boards, each using silver-rich solders and contacts. Goldman Sachs estimates power demand from data centers will rise 165% by 2030 as hyperscalers deploy AI clusters. Every watt of that power infrastructure uses silver, every chip, every switch, every high-speed interconnect. The Federal Reserve just made it worse. Here's where macro policy collides with physical reality in ways that should terrify anyone betting against silver. The Federal Reserve cut rates 3 times in 2025, bringing the federal funds rate down to 4.25 to 4.5%. Normally, that would trigger risk on behavior. Stocks rally, crypto rallies, commodities get left behind. But silver isn't behaving like a normal commodity anymore. It's behaving like a monetary metal with industrial necessity. When real interest rates fall, the opportunity cost of holding silver collapses. When inflation expectations rise, investors pile into tangible assets. When central banks diversify away from dollar reserves, they buy gold and silver. All 3 dynamics are happening simultaneously. The latest inflation data showed consumer prices rising 2.7% year over year in November, below expectations, but still uncomfortably above the Fed's 2% target. Core inflation came in at 2.6%, also below forecast, but elevated enough to keep pressure on real wages. Markets interpreted the softer data as confirmation that the Fed will continue cutting rates in 2026. Futures markets are pricing at least 2 more 25 basis point cuts next year. Lower rates are normally bullish for precious metals. But here's what makes silver unique. It's not just benefiting from monetary policy. It's benefiting from the fact that industrial demand can't stop. Solar manufacturers can't delay panel production because silver hits $67. EV makers can't redesign vehicles mid-production cycle. Data centers can't halt construction when AI infrastructure is the difference between competitive survival and irrelevance. This creates a bidding war between financial demand and industrial necessity. Both sides pulling from the same constrained supply pool. Both sides unable to back down. Financial investors can sell if they want. Industrial users? They must buy at any price or shut down production. That asymmetry is why silver lease rates stayed elevated even after massive shipments arrived in London. That's why premiums persist. That's why this isn't a normal market anymore. The critical minerals designation changes everything. On December 9th, 2025, something happened that most investors missed, but that could reshape silver markets for decades. The United States Geological Survey finalized its 2025 critical minerals list, and silver made the cut. Not as a footnote, not as a maybe. Silver is now officially designated a strategic critical mineral by the U.S. government. Why does this matter? Because critical minerals get special treatment. Domestic production gets prioritized. Supply chains get scrutinized. Export restrictions become possible. Tariffs become likely. When a commodity transitions from industrial input to strategic resource, market dynamics change fundamentally. Bloomberg reported that fear of sudden premiums in America has made some traders hesitant about sending metal out of the country. The Section 232 investigation into critical minerals, including silver, remains unresolved. President Trump could impose tariffs or trade restrictions at any point. That uncertainty is keeping silver inside U.S. borders, creating artificial tightness in other markets. And here's the brutal irony. The U.S. doesn't produce nearly enough silver domestically. America mines roughly 40 million ounces annually, compared to Mexico's 180 million ounces and Peru's 120 million ounces. If tariffs get imposed, U.S. industrial users face higher costs and potential shortages. If tariffs don't get imposed, the mere threat keeps global supply chains distorted. Either way, the market stays tight. The critical minerals designation also signals something deeper. Governments recognize that silver isn't just valuable, it's essential. You can't build modern infrastructure without it. You can't deploy clean energy at scale without it. You can't manufacture cutting-edge electronics without it. Once that recognition becomes policy, once silver transitions from commodity to strategic asset, the pricing paradigm shifts permanently. What happens next? The $70 question. Silver closed today around $67 per ounce. The psychological barrier of $70 looms large. Multiple analysts are publicly forecasting that silver will test 70 before year-end, less than 2 weeks away. Some are going further. FX Empire published a note suggesting silver has a decent chance to reach 70 ahead of the new year, with the gold to silver ratio pulling back below 65, signaling continued outperformance. But the real forecasts get interesting when you zoom out. Reuters quoted strategists projecting silver could climb toward $75 per ounce by the end of 2026. Deutsche Bank's outlook pegs average 2026 prices around $55, though spot prices already trade above that level, suggesting conservative estimates are being overtaken by market reality. Some algorithmic models and technical analysts are throwing out numbers that sound insane until you understand the structural dynamics. Wallet investors' long-term model projects silver reaching the low 80s by 2030. Other commodity forecasts suggest silver could exceed $100 per ounce if industrial demand continues accelerating while supply deficits persist. Let's be clear about something. Predicting exact silver prices is impossible. Too many variables, too much volatility. But what we can say with confidence is this. The structural drivers pushing silver higher aren't temporary. They're multi-year, multi-decade trends. Solar deployment will accelerate through 2030. EV adoption will continue growing. AI infrastructure will expand. Central banks will keep diversifying. Mine supply won't magically double. Those fundamentals create a floor under silver prices that didn't exist in previous rallies. Even if speculative demand collapses tomorrow, industrial users need to keep buying. Even if ETF inflows reverse, solar manufacturers can't stop ordering. That inelasticity, that inability of demand to respond to price, is what makes this cycle different. Could this actually crash the bear case? I know what you're thinking. 1,800 words of bullish narrative, and now we're talking crashes. Welcome to intellectual honesty. Yes, silver could correct sharply. Yes, there are scenarios where $67 becomes $50 or even $40 temporarily. Let me walk you through how that happens. First scenario, tariffs disappear. If the Section 232 investigation concludes with no new levies on silver, the fear premium evaporates. Traders who hoarded metal in anticipation of restrictions suddenly have excess inventory. That silver floods back into the market. Lease rates collapse, premiums normalize, prices correct sharply. TD Securities' Daniel Ghaly warned explicitly that a no tariffs outcome could sharply change liquidity dynamics and trigger what he called a risky blow-off top. Second scenario, recession. If the global economy tips into recession in 2026, industrial demand for silver weakens, solar installations slow, EV sales decline, data center construction pauses. The deficit shrinks or even flips to surplus temporarily. Financial investors flee risk assets, including silver. Prices drop hard and fast. Third scenario, central bank intervention. If silver lease rates spike again to 30 or 40%, threatening systemic disruptions in London markets, regulators could step in. Trading halts, position limits, forced liquidations of large holders. It happened with nickel on the London Metal Exchange in 2022. It could happen with silver if conditions become extreme enough. But here's why even the bear cases don't terrify me as much as they should. They're all temporary. Tariff uncertainty resolves one way or another. Recessions end. Interventions create buying opportunities. Meanwhile, the structural supply deficit continues. The industrial demand trends continue. The strategic importance continues. Silver crashes have historically been spectacular buying opportunities for anyone with the stomach to buy and to panic.